The reality is we're ending up at the gates of hell. We have fiscal policy that is increasingly constrained, and we have energy policies that has been so dumb. I mean, so stupidly dumb.
Welcome to another edition of Global Macro Update. I'm Ed D'Agostino from Malden Economics, and I am so pleased to be bringing to you today Louis Gav from Gavekal Research. Louis is my number one favorite person to go to when thinking about all things global macro and how they relate to investors and investing. We are going to cover inflation, interest rates, China, Europe. And at the end of the video, we're going to talk about specific things that investors can do to protect their portfolio today and beyond. I hope you enjoy my discussion with Louis Gav of Gavekal Research. Louis Gav, it's great to see you. Thanks for joining us today. I've been looking forward to this conversation all week.
Thanks. Thanks for having me. I've been looking forward to as well. And now that you've said all these kind words, I think I should stop right here. And I can only disappoint after this. But thank you very much for having me.
There's not much to talk about on a weekly global macro update in this environment. And I say that completely in jest because it's such a complex environment. I wanted to chat with you first about maybe what isn't being reported as much in the financial media. Everyone is talking about interest rates and Fed policy. With regard to interest rates, where are interest rates going? How far will the Fed go? Will they pivot? But there's another side of the Fed's activity that I don't think is getting a lot of attention. I rarely hear it mentioned, and that is the acceleration of QT, or quantitative tightening, the Fed letting their balance sheet roll off. I'm wondering what your thoughts are on QT when it ramps up to its full level, the impact of it, how far the Fed will be able to go on that side because of the increasing cost of financing the U.S. government's debt. What kind of impact do you think QT has on their overall goals and the economy?
First again, yeah, great to catch up. And I think there's a pretty good reason we haven't been hearing about QT is that it hasn't been happening. For all the talk about how the Fed is going to shrink its balance sheet, the reality is this has not happened. I think if you go back to when inflation really started to break out on the upside, which is really in March 2021. That's the first time it starts to break out above 2%. And from there on out, sort of month in, month out, inflation comes out either higher or much higher than expected. And throughout from March 2021 to May 2022, the Fed actually continues to expand its balance sheet. It continues with quantitative easing in the face of 3% inflation prints, and 4%, and 5%, and 6%, and so on. And only starting in May 2022 does the Fed stop expanding its balance sheet. Now, since then, I don't think you can qualify what's occurred since May 2022 as QT, because the Fed balance sheet is, roughly sidelined. Sure, there's been a little bit of shrinkage, but very, very marginal. So far we haven't seen any quantitative tightening, and the question is, why not? Why is the Fed balance sheet not shrinking in the face of 8.5% inflation rate? And I think you put your finger on it. The answer is pretty simple, and that is that you need the central banks of the world need to be there to help the vast amounts of debt that governments need to roll over. The big difference this time around compared to last time when inflation was 8.5% of GDP in the 1970s is that in the 1970s, debt to GDP in most Western nations was anywhere from 30 to 60% of GDP. Today, you'd be hard pressed to find a country that has a debt to GDP level that's lower than 100%, and sometimes 120, 130. And so, all these central banks, I think, are sort of stuck in that if they stop rolling over the government debt, you could easily have a debt crisis. And, on this, I think looking at the Bank of Japan and what the Bank of Japan has been doing is full of messages. Because, the Bank of Japan, 4 or 5 months ago, came out and said, you know what, we're embracing yield curve controls. We know that our government will be in trouble if bond yields go above 25 basis points. So we're just going to go ahead and just buy a limitless number of bonds at if ever the yields start approaching 25 bips. Now everybody today is looking at the Bank of Japan thinking, well, that's crazy. Let's sell the yen and sell the JGBs because at some point that won't work. But in my career, I'm just a tad younger than you are. We've just established. But in my career, throughout my career, I've seen the Bank of Japan be a sort of trailblazer for other central banks. The Bank of Japan was the first central bank to go to zero interest rates, and at the time, everybody thought that's stupid. Zero interest rate that makes no sense. That can't work. And 2 years later, everybody had zero interest rates. And then it was the first one to do quantitative easing. And when it did quantitative easing, everybody's like, well, that's stupid. And then everybody did quantitative easing. And now that the Bank of Japan is doing yield curve controls, everybody's saying, oh, that's stupid. But how long until the Fed is openly doing yield curve controls? How long until the ECB is openly doing, for all intents and purposes, the ECB is trying to do spread curve control.
Right.
But so all this to say that, but all this to say that, for all the talk about quantitative tightening, we're not seeing it. Now, I'm happy to change my mind when the facts change. Once the Fed starts to do quantitative tightening, sure, they'll have a market impact. And I think the market impact will be broadly negative for asset prices around the world. But for now, let's not kid ourselves that the Fed is withdrawing liquidity out there. It's not.
So the Fed's Atlanta division, the Bank of Atlanta, there was a paper issued in July talking about how if they let $2.5 trillion roll off the balance sheet over a few years, that it would be equivalent to approximately a 75 basis point rate hike, which seems, like a big underestimation. I mean, I don't know.
I would say so. 2.5 trillion is what 10% of U.S. GDP.
Right.
That seems 10% of U.S. GDP, 75 basis points. I didn't graduate in maths, but it seems not the same. Seems not the same.
So you brought up Bank of Japan. How do you see inflation in Japan relative to the U.S. and maybe Europe? Is it drastically higher in Japan right now?
Oh no, not at all. Inflation, you would think it would be, right? It's because of the weak yen, because they have to import all their energy, unlike you in the U.S. That's mostly you guys are give or take energy self-sufficient. Japan has none of these advantages, but inflation rate in Japan is what 2.5%.
It makes no sense. So does it make sense to anyone? Does it make sense to you?
It does. It does to the extent, and there's also no inflation in China, and there's no inflation in most Asian countries. Well, no inflation. There's obviously inflation in energy. There's obviously inflation in food prices, but I think it comes down to a number of. It comes down to what do you think is behind today's inflation, right? Do you think it's all caused by the supply chain dislocations linked to COVID? That's the story that we were sold by central banks 6 or 9 months ago.
Right.
Or do you think that it's linked to deglobalization? Or do you think that it's linked to the crazy fiscal and monetary policies that a number of countries adopted during the COVID period? I mean, look, for 2 years, broad U.S. monetary aggregates grew by over 20%, which they'd never done in their whole history. And so, is today's inflation rate, what's behind it? If, like me, you think it's 1, deglobalization, 2, the fact that we're in an energy crisis, 3, the fact that we followed crazy monetary and fiscal policies during COVID. Well, if you look at places like Japan, Japan isn't really embracing deglobalization like the Western world. They're not actively picking fights with China. They're not actively picking fights with Russia. I mean, case in point, initially Japan said, yeah, like the rest of the world, we're going to block Russia because they're bad guys. And in the past 6 weeks, Japanese energy imports from Russia have quietly gone out and just ramped up massively. So they're a little bit like, discretion's the better part of valor. And, quietly they're doing deals on the back end and, re-importing the gas, re-importing the coal, re-importing the iron ore. So you've got that part. And then, in Japan during COVID, they didn't follow crazy monetary and fiscal policies in the way we did. They just didn't. They didn't turn around and say, "Oh, you know what? We'll pay everybody $2,000 to stay at home and play Nintendo." And so, today we're paying the price of that. So, again, if you think that the inflation rate is just a consequence of the supply chain dislocations, then indeed you might look at Japan and China and wonder, well, how come these guys aren't suffering? But if you think, no. Today's inflation rate is the price we pay for the crazy policies of 2 years ago. It's the price we pay for actively embracing deglobalization and shutting out China and shutting out Russia, which, politically is maybe something we want to do, but let's not kid ourselves. It doesn't have a cost.
Sure.
It's Thomas Sowell that says there's no free ride. There's only policy choices. And so, we choose to block out China. We choose to block out Russia. That's fine. The price we pay is inflation. And, let's be honest about this. It's a policy choice. And today that the cost is inflation.
So clearly there's deglobalization when it comes to Europe and the US versus Russia. What about with China? I mean, we are seeing steps, the CHIPS Act, other policy moves to break away, but at the corporate level, at the industrial level, where the rubber meets the road, is there deglobalization happening at a meaningful scale and pace right now?
I think there is, and I think it predates this Russia-Ukraine invasion. I think, to be honest, it all started in 2018 when the Trump administration decided to weaponize the semiconductor industry. If you go back to 2018, what happened was the Trump administration said, "Okay, no more semiconductors for Huawei, no more semiconductors for ZTE." That was a massive shock for China. As they looked at it, Huawei was their national champion. This was their industrial jewel. This was the first time they had managed to build a global brand from scratch, and one that was, gaining market share at the very pinnacle of technology. Now we can debate, of course, that they did this by stealing patents and by stealing foreign technology, et cetera. But from a Chinese point of view, all of a sudden it felt like we've got a winning company, and the U.S. just send their goons to take it out at the knees and basically crush this thing. Hence, we must become independent of the U.S. on the semiconductor front. We must become independent on the energy front. We must become independent on the currency front. So deglobalization really kicked into gear massively in 2018. And I think
when you say that China realized they needed to become independent, was that because of the actions of the Trump administration, or do you think that was their plan all the way along? And the reason I ask is I think
it was part of their plan, right? It was the sort of China 2025 agenda. There was a lot of that, no doubt. Having said that, I think the weaponization of the semiconductor industry highlighted for China a massive weakness that they had and that perhaps they didn't realize they had, which was their dependence on foreign semiconductors. That weakness and dependency was always there. I'm not sure they realized it. It was. And following that, China turns around and says, okay, we're going to spend hundreds of billions building our own semiconductor industry. We're going to go to Taiwan and lift entire teams from TSMC or UMC. And we're going to try to build this from scratch. Now, this is an extremely challenging endeavor, if only because you don't have the proper machine tools. Those are made by ASML in the Netherlands. It's an extremely challenging tool to begin from scratch. But having said that, imagine you're Samsung Electronics. Imagine you're TSMC or whoever else. And now you've got China saying, I'm going to spend hundreds of billions to become a competitor to you. You're probably thinking, well, I'm not going to do any capital spending, right? I'm going to hold back on my CapEx. And that's how you grew into the shortage that we saw in 2020, 2021, because everybody, 2019 was the first year in like 20 years since the Asian crisis where TSMC's CapEx actually fell. Because again, you're seeing this, you see this trend of China's going to spend all this money, because building those fabs now is tens of billions of dollars. So if you get your timing wrong,
right,
or if China undercuts you, it's a different proposition. So the bottom line is you had an industry that was working perfectly well, the semiconductor industry. Of course, it had its boom and bust cycles, etc. And then you throw government intervention on top of it from the US and from China, which creates massive uncertainty if you're a businessman. And most businessmen with uncertainty tend to hold back. It's like, oh, not sure. Just gonna, don't want to do anything stupid. And so that's that's where we were. And from there, from all this negative feeling, uncertainty, etc., the message was very clearly sent to every producer out there. Look, if you can, move your production away from China, right? And so you see this Apple saying, look, we're going to do more in India, but they find it challenging to do. We're going to do more in Vietnam, but they find it challenging to do. But the desire very much is there to move. And anybody who can move from China is moving from China. Now, the reality is, if they hadn't moved before, it's because China was a better price point, right? If producing out of Vietnam or India was a better proposition, you would have already done this. You're shifting your production not because of cost reasons, but because of political reasons, because of the political risk that is now comes with producing in China, and so that comes at a cost, and so
Sure.
you end up with the supply chain dislocations that we've seen, or just higher cost of productions.
So do you
And it is
agree
happening.
that
It's happening.
do you believe that this is a trend, this deglobalization trend between China and the West is going to continue? And if so, is this going to be one of the main drivers of a higher baseline level of inflation, where maybe in years past we're used to 1.5% inflation and a Fed talking about we want to get it to 2%, and now it's going to be kind of stuck at 4% or so? Is that a scenario that you see feasible and probable?
I see it not only as feasible and probable, I see it as extremely likely. First, I see no reason to think that the U.S. and China are going to sit down and have a big kumbaya moment. If anything, every month that goes by, they seem to be getting further apart. Last month Nancy Pelosi visiting Taiwan, and they don't seem to be playing nice and playing friendly. Far from it. As for the 4% inflation, let me put it to you this way. My core belief, and I've argued this at the SIC conferences for the past few years, et cetera, is that inflation today, it's not a bug, it's a feature. Policymakers wanted to get us here. I mean, look, the Fed employs more than 400 PhDs, right? Out of 400 PhDs, do you think not a single one would have said, hold on, wait, if we grow broad money supply in the US by over 20% for 2 consecutive years, we're going to end up with inflation? Out of 400 PhDs, you don't think it occurred to one of them? Did none of them take Econ 101? When you're running, 12 months ago, 18 months ago, they were telling us they wanted inflation. They were actively saying, whether the ECB, the Fed, etc. Now, I think there was a little bit of hubris with them, where they thought, ideally we get 3.5%, 4% inflation, and we get that inflation rate there, and it stays there, and that deals with the debt problem. And over time, the debt gets eaten away by the high inflation rate, like happened in the 1950s and 1960s. Except we now live in an accelerated world. You don't have any more capital controls. You live in a much more globalized economy. And so your inflation rate, it goes to 4, it goes to 5, it goes to 6. And all of a sudden it starts getting uncomfortable. 4% isn't that big a deal. 6 starts getting uncomfortable. 8 is a downright political issue. More importantly, as my friend Vincent Deluard often says, inflation is inflationary. it changes, just like deflation is deflationary. It changes people's psychology, etc. So does inflation. Inflation starts picking up. So now people ask for higher wages, which then feeds. And we're there. We are now in the phase where inflation has become inflationary. And so if you look at, my friend Vincent did this great study looking at all the countries around the world since 1945, where inflation moved above 5%. Once inflation had moved above 5%. And you had hundreds of cases, in Argentina, in Brazil, in South Africa, in the US, lots of different examples. And you look at the number of times where 12 months later, it's below 2%. 12 months later, it's between 2 and 5. 12 months later, it's between 5 and 10. And 12 months later, it's over 10. The reality is 1.6% of the time, it goes to below 2%. 1.6% of the time. And right now, that's what the market is pricing. That's what the market is pricing in. Out of hundreds of examples, since World War II, we're saying, it'll be fine. It'll be below 2% in a year's time. So you're betting on the 1.6% odds. Meanwhile, 20% of the time it's above 10%, and 20% of the time it's between 5 and 10. And that's, and those examples include when central banks really, crank up the level to get things under control, i.e. shrink their balance sheets, et cetera, all the things that the central banks today aren't doing. So, when you look at inflation today, I don't want to answer your question with another question, but do you think energy prices are lower in a year's time? I don't. I think we're in a massive energy crisis. And today's prices reflect the level of underinvestment for the past 10 years. So do you think energy prices are lower? Do you think food prices are lower? I don't. Again, underinvestment, problems with fertilizers, lots of issues. Do you think
food prices won't go down unless energy prices go down, right? I mean, they're very correlated.
They're very tied. Do you think the Fed brings interest rates above the rate of inflation, which historically is what's needed for inflation to roll over? I think no way. Absolutely no way. Right. If they wanted to do that, they would have done it when inflation was at 4. They wouldn't have waited till inflation was 8.5. So all this to say, it's okay, why would you think inflation would be below 2%? I think, to be honest, the onus is on people who think inflation is going to be below 2% in a year's time to argue why that is. Right now, it's going completely the other way.
So let's make a pivot. We'll come back to inflation, but before we do, because I want to tie everything together for investors, before we do that, let's talk a little bit about Europe and the challenges that they face heading into fall and winter with being very dependent on Russia. Russia's going to have so much leverage over Europe heading into the cold season. How do you see that playing out?
Look, I think the only good news about Europe at this point is that everybody knows all the bad news. That's pretty much the only positive thing you can say, because the bad news is downright horrible. Now, whether that bad news is all priced in is a debate we can have. But yes, to your point, Europe's heading into a massive energy crisis. I think Europe's heading into a political crisis because, if you go back 20 years or 25 years, the bargain. Do you remember that old Ben Franklin quote of, if you give up liberty for security, you end up having neither?
Yes.
And in Europe, we were told, give up your freedom on monetary policy, give up your freedom on fiscal policy, give up your freedom on energy policy, and you'll end up with more prosperity. And that was the bargain. That was the European Union bargain that was pushed hard on populations 25 years ago. It's like, if you give up your rights to have your own currency, your own fiscal policy, your own energy policy, you'll end up in a better place in 20 years' time. The reality is we're ending up at the gates of hell, where we've lost control of monetary policy, and and we have an inflation rate such as hasn't been seen in generations. We have fiscal policy that is increasingly constrained, and we have energy policies that has been so dumb. I mean, so stupidly dumb that you put it all together, and the risk is of a significant political crisis, and big strikes, riots, Um, Look, this winter in Europe, you will have energy shortages. You will have energy rationing. Which, by the way, going back to our question on inflation, if you think we can have massive energy shortages in Europe and not have supply chain dislocations for the whole world,
Sure.
that's another inflationary thing. Think of the auto industry. Like, so many auto parts are still manufactured in Europe. Now, you know the old story. If a car takes about 1,500 different parts, and if you have 1,490 parts, you've got an expensive paperweight.
Right.
And this is where we're heading. If you have energy shortages, you're going to have auto parts shortages. You're going to have, and it's not if we are going to have these energy shortages. So no, Europe is in a tough bind, and is going to be both a hit for global growth in the coming 6 months, and potentially a hit, like another boost to inflation at the same time, which is quite a feat, to both hurt growth and boost inflation.
Sure.
But
And
it's very
the
possible that Europe
ECB
ends up doing it.
essentially, can the ECB do anything to mitigate the inflation situation? I mean, because of the debt load of the periphery countries?
Look, what Europe will need to do, Europe's saving grace in all of this, like the silver lining, is that the oil price is actually not so high, right? The oil price is $95. Right now, if you look at the electricity cost in Europe in sort of oil equivalent, it's $1,000 a barrel. If you look at the natural gas price in Europe in oil equivalents, it's $600 a barrel. So what Europe can
Wow.
do this winter is just buy very large, copious amounts of oil from Middle East, from Iran, from the US, from Canada, from anybody who sell it to them, sell oil and burn it for energy, which is, of course, polluting and a stupid way to produce energy. But that's the situation we've left ourselves in.
Sure.
And so the saving grace for Europe is that oil is still not too expensive, one. And two, that moving oil around is actually pretty easy. It's much easier than moving natural gas. It's you put it on
Sure.
boats, you put it on trucks. You can move the oil around. So Europe this winter is going to have no choice but to buy copious amounts of oil, which is very bullish oil, of course, and pretty bearish the euro because they're going to have to pay for that oil in US dollars. So they're going to have to sell euros, buy US dollars to buy all the oil they need. So all that is so as far as the ECB is concerned, that will make for higher inflation rates. Weaker euro, higher oil. Inflation rate in Europe isn't done falling. So what can the ECB do in the face of this? I don't know. I think it's Jim Grant always says, what would you do if you were chairman? What would you do on your first day if you were chairman of the Fed? And he always says resign. That's what I would do if I was chairman. That's what I would do if I was chairman of the ECB.
So we've covered a lot of ground. Let's wrap this up by talking about what would you recommend to an investor in terms of positioning. A world where baseline inflation is going to be higher than we've experienced for decades. Interest rates are going to be higher than we've been used to for certainly the last decade. Energy constraints. What is an investor to do?
Look, I think the first thing to acknowledge is that building a good portfolio, and I know I've talked this at SIC conferences in the past, but building a good portfolio is like building an American football team, right? When you put your American football team on the field, you need players who do different things. If you had a team with 11 John Elways or 11 Dan Marinos,
Sure.
you'd get pummeled
Sure.
every day of the week. So your offensive linemen do a job, and your running backs do a job, and your quarterbacks do a job, and the same is true of a portfolio. Now, the big challenge for investors today is that for the past 30 years, the offensive line, i.e., the anti-fragile part of your portfolio, the part of your portfolio that protected everybody else, used to be government bonds. It used to be U.S. Treasuries or German bonds, so that was your offensive line, and that offensive line no longer works. And you've seen this very clearly in the past year, right? In the past year, in the first 6 months of this year, S&P 500 goes down 20%, and the TLT, the long-dated U.S. Treasury ETF, also went down 20%. And it was like one for one. It was providing no diversification, no protection. So it's a little bit like, you send you off your offensive line on holiday and they came back and they all weigh 120 pounds. They all went on massive diets and they all became cross-country runners, which is great if you want to win a cross-country competition, not so great if you need an offensive line. So the first thing to acknowledge is that bonds no longer do the job in portfolios that you want them to do. So you need to sub them out. If you have an offensive lineman who's not doing the job, you need to take him off the pitch and put somebody else. Now, what is the new anti-fragile asset today? What is the asset that basically behaves with a negative correlation to everything else? I think there's really two of them left. The first is energy. I'm sure you'll have noticed that all year long, days where the market is up, energy is sort of struggling. Days when the market is down, energy is doing well. So energy, which makes sense in an inflationary environment, right? Because today the risk as an investor, I know we're all focusing, and I am as well, on is Powell going to be hawkish at Jackson Hole? Is he going to be dovish?
Right.
Ooh, is it going to be 50 basis points? Is it going to be 70 basis points? 75 basis points? Forget it. Like in 10 years' time, in 5 years' time, this won't matter. What matters is oil going in the next 6 months? Is oil going to $150 or to $50? I mean, that's it. That's what matters. And if oil goes to $150, the rest of your portfolio is destroyed. And that's the simple reality. So the first thing to acknowledge is that today, your new offensive line, your new anti-fragile building block, the thing that protects the rest of your portfolio is energy. And there's lots of different ways you can put that in. You can say, I wanted the high beta way. I'm going to go out and buy coal mines. You can say, I'm going to do it in a conservative way and buy MLPs. Lots of different ways to play this, or I can buy uranium, or I can buy, oil refiners. There's different ways, but by and large, you need a big energy position. Now, the interesting thing is, if your benchmark energy is 4% of your benchmark, really it should be 25% of your portfolio, because it is now, a big separate, it behaves like no other asset. And so again, it's the 300-pound lineman that you just need. So that's the first asset that's anti-fragile. The second asset, I think, that's anti-fragile, and here this might surprise you, but I think it's emerging market bonds. Let me
EM bonds.
EM bonds, and let me explain. A year ago, if a year ago I'd have told you, hey Ed, over the next year, inflation is going to be much higher than expected. The Fed is going to have to sound much more hawkish than anybody expects. U.S. Treasuries are going to move from 1 to 3% yields. S&P's down 20% from its highs. Oh, and by the way, load up on Brazilian bonds, load up on Chinese government bonds, load up on Indian bonds, load up on Indonesian bonds, load up on South African bonds. You'd have said, Louis, you're the stupidest person I know. You've been doing emerging markets for 25 years. And don't you know that when you get into a Fed tightening cycle, emerging markets blow up, emerging markets underperform. The last thing you do is, add risk in emerging markets in a Fed tightening cycle. That's like, every emerging market investor knows that. Except look at this year, amidst a massive underperformance of both U.S. equities and U.S. Treasuries, Brazilian bonds are up for the year. Chinese bond yields have gone from 3 to 275 this year, or 270 this year, just as U.S. bond yields have gone from 1.5 to 3. Indonesian bonds are up for the year, and they're behaving in a way that's completely counterintuitive to what you would expect. And I think that's when things in the market don't behave as you would expect. For me, that's a strong signal. It's it means there's something going on there. And I think what's going on there is that big parts of the world are actually quietly de-dollarizing. If you look at, I think it was 5 or 6 weeks ago, China did its first deal with BHP for iron ore priced in renminbi. And so now all of a sudden BHP is selling iron ore to China, no longer in US dollars, but in renminbi.
Wow.
This is a huge deal for China.
That's a big deal.
Because now China can turn to Rio Tinto, it can turn to Vale. It can turn to a lot of places and say, well, look, I'd love to do business with you, but unless you make it in renminbi, I'm just going to deal with PHP. And so all of a sudden, China's need for US dollars go down, right? And so, as now China's been trying to do this for 12 years. I think this is just, and I've talked about it at your conferences many times. Massive impetus is the sanctions we've put on Russia. For 10 years, China was turning to Russia and saying, hey, Russia, let's trade in renminbi instead of US dollars. By trading in US dollars, we're, instead of having a committed relationship, we're in this sort of ménage à trois here with US Treasury in between us. Let's stop doing that. And Russia was never, that keen. But now Russia doesn't have a choice. Like Russia can't use US dollars anymore. They can't use euros. So now Russia is telling China, yeah, I'll sell oil to you in renminbi. I'll sell natural gas to you in renminbi. I'll sell iron ore. I'll sell coal. I'll sell whatever you want in renminbi. So now China can turn to Indonesia and say, hey, Indonesia, I love your coal. It's so much better than that Russian crap. But, I'm only going to buy your coal if it's priced in renminbi. So all this to say that, yes, we're in a Fed tightening cycle. And yes, we're in an energy crisis, which usually means there's triggers a shortage of dollars in the system. But at the same time, the world's biggest commodity exporter, namely Russia, and the world's biggest commodity importer, namely China, are moving their trade away from the US dollar. So that potentially reduces the need for US dollars. So this, to me, explains why perhaps emerging markets are not doing that badly amidst this, unfolding US dollar liquidity squeeze.
Ramifications for the dollar near term? Not going to be as strong as everyone thinks?
It depends against who, right? Because when we talk about the dollar, you got to talk about somebody who's on the other side.
Sure.
So if you look at the DXY is really a euro proxy because it's euro, a little bit of sterling, a little bit of yen. It's pretty hard. Like the only positive case you can make for the euro is everyone's bearish. I mean, that's it. Like everything else on the euro looks absolutely horrible. It looks horrible technically. The inflation is skyrocketing. You got an energy crisis, a political crisis upcoming. It's like why would you want to own this, right? So if you think, US dollar, euro, sure, you're going to be US dollar. But against the yen, the yen is undervalued. Yen has tons of assets abroad. They've quietly, started to do business with Russia again. They're restarting their nuclear, which to deal with the energy crisis. So against the yen, yeah, I'd be bullish yen. Against all the emerging market currencies, or all the big ones, your Indian rupees, your South African rands, your Canadian dollar, all the EMs. I'd be bullish those.
Louis, I'm going to restrain myself now. I have about 14 more questions I'd like to ask you, but I think this is a good place to wrap. I can't tell you how much I enjoy these conversations and your worldview and your intellect. Thank you so much for sharing some of your time with us today. It's great to see you.
Absolutely my pleasure. Great to see you, Ed. Always.
Cheers. I hope you enjoyed the interview. If you did, please take a moment to drop a comment below and subscribe to our YouTube channel. I'm Ed D'Agostino. Thanks for watching.